Today, we're going to crack open one of the most influential and, honestly, one of the densest reports on Wall Street. It's Bank of America's The Flow Show. Now, our goal here is to cut through all the noise and all the data to see where the big money is actually moving, behind the scenes. So let's dive in and see what the numbers are really telling us.
The report kicks off with this killer line. It just perfectly sums up the mood in the market right now. The feeling out there is that all the big worries, tariffs, taxes, geopolitics, they're all kind of fading away. And the report's take is brutally simple. The moment those leaders shake hands, that's it. That's the absolute peak, the top.
And that optimism, man, it is everywhere. The general feeling, the consensus, is that the wall of worry is pretty much behind us. Investors seem super confident, like they're getting ready for nothing but blue skies ahead. But just how confident are they really? Okay, look at this. This is just incredible. I mean, check out how lopsided this is. You've got 60% of investors betting on a perfect Goldilocks scenario. Rates down, stocks up. Another 30%? They're ready for an inflation bubble. So that means 9 out of 10 investors are positioned for stocks to go up. But the number that really gets me, the truly stunning number, is this last one. 0%. Literally, nobody expects deflation. Not a single person sees a storm cloud on the horizon.
All right, so this is where the story takes a really sharp turn. Because if everyone is so bullish, you'd think there'd be this tidal wave of cash just flooding into the stock market, right? But is that what's actually happening? Let's follow the money.
So, the story we keep hearing is all about this incredible confidence, this widespread bullishness. But the money? The money is telling a completely different story. In just 1 week, a massive $41.7 billion was pulled out of stocks. Now, to be fair, the report says this number was skewed by a couple of huge liquidations, but still, that's a shocking number. So if the money's leaving stocks, where did it all go?
It went into cash. A stunning $106.7 billion flooded into the safety of money market funds. That's the biggest weekly inflow we've seen all year. And this, right here, this is our central mystery. Why are investors saying one thing, that they're bullish, but doing the complete opposite? They're talking the talk, but they're parking their cash like they're getting ready for a storm.
So to solve this puzzle, we have to look past all the talk. We need to dig into Bank of America's own proprietary tools. These things are specifically designed to measure what investors do, not what they say. And that gives us a real contrarian view of the market.
So the first tool in the box is their bull and bear indicator. It takes a ton of data, fund flows, market signals, you name it, and crunches it into a single number. You can think of it like a professional-grade mood ring for the market. If it goes above 8, that's extreme greed, a big sell signal. And if it drops below 2, that's extreme fear, a buy signal.
So where is it right now? It's at 6.1. Now, technically, that's neutral. It's not at that extreme sell level yet. But, and this is the crucial part, it's falling. It's heading away from euphoria, not towards it. And that lines up perfectly with all that cash we just saw running for the sideline.
Okay, now get ready for this. This might just be the single most powerful piece of data in the whole report. So BOA keeps track of the cash levels of professional fund managers. And last month, their cash levels dropped so low that it triggered a major sell signal. This has only happened 20 times since 2002, and in the months that followed, global stocks fell. Not sometimes, not usually, 100% of the time. That is a perfect cautionary track record. And we might also be seeing some cracks forming in the actual economy. Just look at this startling trend. The unemployment rate for recent college grads has more than doubled in about a year and a half. I mean, what's going on there? The report brings up a pretty troubling possibility, that this could be one of the first signs of AI disrupting the white-collar job market. And that's a huge risk that the market's current euphoria just seems to be ignoring.
So, how does all this stuff build into a bigger global picture? Well, the report goes beyond just the US market and lays out this fascinating geopolitical idea, one that totally flips a common phrase on its head.
America first equals US dollar last? Wow.
I mean, that's a provocative thought, right? The argument here is that protectionist policies, the ones designed to boost the U.S., could actually end up speeding up trends that are already happening, like Japan finally ending deflation or China rebalancing its economy toward consumers. And that could, ironically, weaken the U.S. dollar and make international stocks the place to be.
This all feeds into what the report calls the peace trade. So if geopolitical tensions actually ease up and the focus shifts to trade deals, who wins? Well, according to this theory, it's the big oil importers like Japan, China, and India. And who could lose out? The report points to defense stocks, the Middle East, and even some of the big U.S. tech companies as potential underperformers in this kind of scenario.
Okay, so this brings us to our final piece of the puzzle. If the outlook is for peace and a weaker dollar, why is the report still so bullish on gold? It just seems like a total contradiction, doesn't it?
So let's just ask the question directly. If geopolitical risk is fading, why on earth would anyone need a safe haven asset like gold?
Well, the answer is that Bank of America's case for gold isn't just about hedging against war. They see it as a hedge against something totally different, a politically motivated push for a boom and bubble economy. They believe we're at the start of a whole new decade of inflation. It's a bet on the long-term debasement of the U.S. dollar. And it's a hedge against this wild card idea that central banks might actually be forced to revalue their gold just to manage all their debt. It's a much deeper, much more complex story.
So this is where we're left. On the surface, you have market sentiment that's screaming, all systems go. But when you actually follow the money, when you look at these contrarian signals and the deeper trends in this report, a very different picture starts to emerge. It's a story of caution, of hedging, of looking way beyond the obvious. So yeah, the crowd sees a green light, but this report is flashing a bright, cautionary yellow. And the question you have to ask yourself is, where is the smart money really going?